quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. If you've ever looked at the financial markets and felt completely overwhelmed, this is exactly where the journey begins. Forex trading is often presented as something complex, fast-moving, and only accessible to professionals. But the reality is very different. At its core, Forex trading is simply the exchange of one currency for another, and it underpins almost every aspect of the global economy. Every time a business imports goods, every time a tourist travels abroad, and every time a central bank adjusts policy, currencies are being bought and sold. What you are about to learn is not just how trading works, but how the entire system fits together. This is important because most beginners try to jump straight into strategies without understanding the foundation. That approach almost always leads to confusion and losses. Instead, this video is designed to build your understanding from the ground up in a way that mirrors how professional traders think. By the end, you will not only understand what Forex trading is, but also why currencies move, how opportunities are created, and what it actually takes to operate in this environment with structure and discipline. Now, before going any further, it is important to set expectations correctly. Forex trading is not a shortcut to easy money. It is not a system where you press a button and profits appear. In fact, the majority of people who approach trading with that mindset fail very quickly. The reason is simple. Markets are competitive environments, and every price movement represents the combined actions of banks, institutions, corporations, and traders across the world. So when you enter a trade, you are effectively participating in that global competition. This is where most beginners get it wrong. They focus on outcomes, on how much money they can make, rather than on understanding how the market actually works. In this video, the focus will be completely different. The goal is to build a structured understanding where every decision is based on logic rather than emotion. You will learn how to think in terms of probabilities, not certainties, and how to approach trading as a process rather than a gamble. This shift in mindset is what separates those who last in the market from those who disappear within months. So what exactly is the Forex market? Forex stands for foreign exchange, and it is the largest financial market in the world. Unlike stock markets, which are centralized and operate through exchanges, the Forex market is decentralized. That means there is no single location where all trading happens. Instead, it operates through a global network of banks, financial institutions, brokers, and traders. This is critical to understand because it explains why the market is open almost 24 hours a day, 5 days a week. When trading ends in one region, it begins in another. This continuous flow of activity is what creates opportunities. At its simplest level, Forex trading always involves a currency pair. You are simultaneously buying one currency and selling another. For example, if you trade Euro-US dollar, you are buying euros while selling United States dollars, or vice versa. Every price you see is simply the relative value of one currency against another. This relative nature is fundamental, and it forms the basis of everything that follows in trading. Now, this is where it starts to become more interesting. Currency prices do not move randomly. They move because of underlying economic forces. These forces include interest rates, inflation, economic growth, employment data, and central bank decisions. For example, if a country has strong economic growth and rising interest rates, its currency tends to become more attractive to investors. That increased demand can push the currency higher. On the other hand, if an economy is weakening or interest rates are falling, the currency may lose value. This is why professional traders spend so much time analyzing macroeconomic conditions. They are not just looking at price movements. They are trying to understand the drivers behind those movements. This is a key distinction. Beginners often focus on what the market is doing, while professionals focus on why it is doing it. That difference in perspective is what creates a real edge over time. At this stage, it is important to understand how you actually participate in the market. As a retail trader, you access the Forex market through a broker. The broker provides a trading platform where you can place buy and sell orders on different currency pairs. When you open a trade, you are essentially speculating on whether the value of one currency will rise or fall relative to another. If your analysis is correct, you make a profit. If it is incorrect, you take a loss. Now, this might sound simple, but there is a deeper layer to it. Every trade you take involves risk. There is no certainty in trading, only probabilities. This is why the focus is not just on finding opportunities, but on managing risk effectively. Even the best traders in the world are wrong a significant portion of the time. What separates them is how they manage those losses and how they structure their trades over the long term. Understanding this early on will save you from one of the biggest mistakes beginners make, which is assuming that success in trading comes from being right all the time. Now that you understand what the Forex market is and how you access it, the next step is to understand how prices are actually quoted and how trades are measured. Every currency pair has a price, and that price represents how much of the second currency, known as the quote currency, is needed to buy 1 unit of the first currency, known as the base currency. So when you see euro US dollar trading at 1.10, it means 1 euro is worth 1.10 United States dollars. This structure is consistent across all pairs, and it is essential to internalize it because it directly affects how you interpret movement. When the price rises, it means the base currency is strengthening relative to the quote currency. When the price falls, the opposite is happening. This might seem basic, but misunderstanding this is one of the most common early mistakes. Precision in interpretation is critical because every decision you make will depend on how you read these movements. Building on that, you need to understand how price movement is measured in trading. This is where the concept of a pip comes in. A pip is simply a standardized unit of movement in a currency pair. For most pairs, it is the 4th decimal place. So if euro US dollar moves from 1.10 to 1.1001, that is a 1 pip movement. While this may seem small, in trading, these movements are magnified through position size. This is where the real impact comes from. The value of a pip depends on how large your trade is, so a small movement in price can result in a meaningful gain or loss depending on your exposure. This is why position sizing becomes such a critical concept later on. It is not just about predicting direction, it is about controlling how much each movement affects your account. This is where many beginners underestimate risk because they focus on the direction of the trade without fully understanding the implications of size. Now, this leads directly into one of the most important concepts in trading, which is leverage. Leverage allows you to control a larger position in the market with a relatively small amount of capital. For example, with leverage, you might control a position worth £10,000 with only a fraction of that amount in your account. On the surface, this seems like a major advantage because it allows for larger potential profits. However, this is also where risk increases significantly. Leverage amplifies both gains and losses. This is where most traders get into trouble. They focus on the upside without fully appreciating the downside. A small adverse movement in price can lead to a disproportionately large loss if leverage is not managed properly. Professional traders treat leverage with caution. They see it as a tool, not an opportunity to take excessive risk. Understanding this distinction early is essential because misuse of leverage is one of the fastest ways to lose capital in the Forex market. Another key element you need to understand is how trades are actually executed. When you enter a trade, you are typically choosing between two actions, buying or selling. If you believe a currency pair will rise, you take a buy position. If you believe it will fall, you take a sell position. This flexibility is one of the defining features of Forex trading. Unlike many other markets, you can profit from both rising and falling prices. However, this also requires clarity in thinking. You are not just deciding whether a market is good or bad. You are making a relative judgment between two currencies. This is where beginners often oversimplify the process. They might think a currency is strong, but fail to consider whether the other currency in the pair might be even stronger. Trading is always relative, and this relative thinking is a core part of developing a professional mindset. At this point, you have the fundamental building blocks, but now it is important to connect them into a structured understanding. Forex trading is not about isolated concepts. It is about how these concepts interact. Price quotes, pick movements, leverage, and execution all come together to form the mechanics of trading. But mechanics alone are not enough. This is where most beginners stop, and it is why they struggle. They understand how to place trades, but not how to think about them. Moving forward, the focus will shift from what trading is to how decisions are actually made. This is where the real depth begins. Because understanding the mechanics is only the first step. The real skill lies in interpreting information, managing uncertainty, and making consistent decisions under pressure. This is where the transition from beginner to structured trader truly begins. Now that the mechanics are clear, the next step is to understand what actually drives decision making in trading. This is where the concept of an edge comes in. An edge is simply a repeatable advantage that gives you a higher probability of success over a series of trades. It is not about certainty. It is not about predicting every move correctly. Instead, it is about stacking the odds slightly in your favor and then executing consistently over time. This is where most traders misunderstand the game. They search for perfect entries or guaranteed signals when in reality no such thing exists. Professional traders are comfortable with uncertainty. They focus on scenarios where the probability is slightly skewed in their favor, and then they rely on discipline and risk management to make that edge meaningful over time. Without an edge, trading becomes random. With an edge, trading becomes a structured process. This naturally leads into the concept of probabilities, which is at the core of all professional trading. Every trade you take has an uncertain outcome. Even the best setups fail. What matters is not whether a single trade works, but how a series of trades performs over time. This is a crucial shift in thinking. Instead of asking, will this trade win? The better question is, does this trade align with my edge? And is it worth taking based on probability? This is how professionals operate. They detach from individual outcomes and focus on the long-term distribution of results. This is where consistency comes from. When you start thinking in probabilities, losses stop feeling like failures and start becoming part of the process. This is one of the most important psychological transitions you will make as a trader. Now, this is where risk management starts to take center stage. If probabilities define your edge, then risk management determines whether that edge actually translates into profitability. You can have a good strategy, but without proper risk control, it will not survive. Every trade must have a defined level of risk. This is typically done through position sizing and predetermined exit points. The goal is simple. When you are wrong, you lose a controlled, acceptable amount. When you are right, you allow the trade enough room to generate meaningful returns. This balance is what creates a positive outcome over time. Most beginners do the opposite. They risk too much on individual trades and fail to control losses. This leads to volatility in their account and eventually significant drawdowns. Professional traders focus on survival first. Profitability comes as a result of that discipline. At this stage, it is also important to introduce the idea of time horizons. Not all traders operate in the same way. Some take positions that last minutes, while others hold trades for days or even weeks. The key point here is that your approach must be consistent with your strategy and personality. There is no universally correct time frame. What matters is that your decisions are structured and repeatable. This is another area where beginners struggle. They jump between different styles, reacting to short-term movements without a clear framework. This leads to inconsistency and confusion. Professional traders, on the other hand, operate within defined parameters. They know what they are looking for, how long they expect trades to develop, and what conditions would invalidate their idea. This clarity reduces emotional decision-making and improves overall consistency. Finally, you need to understand the role of discipline in bringing all of this together. Discipline is not just about following rules. It is about executing your process consistently, regardless of recent outcomes. This is where most traders break down. After a loss, they hesitate or try to avoid the next trade. After a win, they become overconfident and take unnecessary risks. Both behaviors are destructive. The market does not reward emotion, it rewards consistency. Discipline ensures that your edge, your risk management, and your decision-making process are applied in the same way over time. This is what allows the probabilities to play out. Without discipline, even the best strategy will fail. With discipline, even a modest edge can become highly effective. This is the foundation upon which everything else in trading is built. Now, this is where everything begins to come together at a deeper level. Up to this point, the focus has been on understanding how the market works and how decisions are structured. But now the question becomes, how do you actually approach a trade from start to finish? Professional traders do not enter the market randomly. They follow a structured process. It begins with identifying a potential opportunity, but more importantly, it involves defining exactly what needs to happen for that opportunity to be valid. This is where clarity becomes critical. Before entering a trade, a professional trader already knows where they are wrong. They know where they will exit if the market moves against them, and they know what conditions would justify staying in the trade. This level of preparation removes uncertainty during execution. Most beginners do the opposite. They enter first and think later. That approach leads to emotional decision-making and inconsistent results. This brings us to the concept of a trading plan. A trading plan is not just a vague idea of what you want to do. It is a structured framework that defines how you approach the market. It includes your edge, your risk management rules, your preferred market conditions, and your execution process. Think of it as a set of rules that guide every decision you make. Without a plan, you are reacting to the market. With a plan, you are operating within a controlled system. This is a major distinction. A plan does not guarantee success, but it creates consistency. And consistency is what allows you to evaluate performance properly. If every trade is taken under different conditions, you cannot learn from your results. But if your approach is structured, patterns begin to emerge. You can identify what works, what does not, and where adjustments need to be made. Now, this is where most traders underestimate the importance of data. Trading is not just about intuition or instinct, it is about evidence. Every trade you take provides information. Over time, this information becomes one of your most valuable assets. Professional traders track their trades in detail. They record why they entered, how the trade developed, and what the outcome was. This process is often referred to as journaling. It may sound simple, but it is one of the most powerful tools for improvement. Without it, you are relying on memory, which is often biased and unreliable. With it, you have objective data that allows you to refine your approach. This is how trading evolves from guesswork into a structured, data-driven process. Another critical concept at this stage is understanding market conditions. Not every environment is suitable for every strategy. Sometimes the market is trending, moving consistently in one direction. At other times it is ranging, moving sideways without clear direction. There are also periods of high volatility where price moves aggressively and periods of low volatility where movement is limited. Each of these conditions requires a different approach. This is where most traders struggle. They try to apply the same method in all environments, which leads to inconsistent results. Professional traders adapt. They recognize the current conditions and adjust their expectations accordingly. This does not mean constantly changing strategies. It means understanding when your approach is likely to perform well and when it is not. This awareness alone can significantly improve performance. At this point, it is important to address one of the biggest misconceptions in trading, which is the idea of constant activity. Many beginners believe that being active in the market leads to more opportunities and therefore more profit. In reality, the opposite is often true. Overtrading is one of the fastest ways to lose money. Every trade carries risk, and unnecessary trades increase exposure without improving probability. Professional traders are selective. They wait for conditions that align with their plan. This patience is not passive. It is deliberate. It is based on the understanding that not all opportunities are equal. Some trades have a higher probability of success than others, and the goal is to focus on those. This requires discipline and restraint, especially in a market that is constantly moving. Learning when not to trade is just as important as learning when to trade. Now, this is where we step into how professional traders actually think at a deeper level. One of the defining characteristics of experienced traders is that they do not see the market as random noise. They see structure. They understand that behind every movement is a flow of capital driven by institutions, central banks, and global economic forces. This perspective changes everything. Instead of reacting to price movements, they interpret them. They ask what is driving the move, who is participating, and whether that movement is likely to continue. This is what creates a more informed decision-making process. Most beginners focus only on the surface level, what price is doing right now. Professionals focus on context. They want to understand the broader narrative behind the movement because that is where higher quality opportunities tend to emerge. Another key shift in professional thinking is the acceptance of uncertainty. This might sound counterintuitive, but it is one of the most important principles in trading. There is no way to know with certainty what the market will do next. Even the most well-researched trade can fail. Professionals do not fight this reality. They build their entire approach around it. They operate on the basis that any single trade can be wrong, and they structure their risk accordingly. This is why they remain calm during losses. It is not because they enjoy losing, but because they expect it as part of the process. Beginners often struggle here because they attach too much meaning to individual trades. They see losses as mistakes rather than as a normal outcome within a probabilistic system. This difference in mindset is what allows professionals to remain consistent over time. Now, this is critical. Professional traders think in terms of distributions, not individual outcomes. What this means is that they are focused on how their strategy performs over a large number of trades, not just one or two. If you imagine flipping a bias coin that lands slightly more often on one side, you would not judge its effectiveness after a few flips. You would need a large sample to see the advantage play out. trading works in exactly the same way. A valid edge only becomes meaningful over time. This is why consistency in execution is so important. If you constantly change your approach, you never allow that distribution to develop. This is one of the main reasons why traders struggle to become profitable. They interrupt their own process before it has a chance to work. This also leads into how professionals manage expectations. They do not expect every week to be profitable. They do not expect smooth, linear growth. They understand that performance comes in cycles. There will be periods of strong performance and periods of drawdown. The key is maintaining stability throughout both. This is where emotional control becomes essential. When performance is strong, there is a temptation to increase risk unnecessarily. When performance is weak, there is a temptation to abandon the strategy entirely. Both reactions are harmful. Professional traders remain stable. They trust their process, provided it is based on sound logic and evidence. This level of consistency is what allows them to navigate the inevitable ups and downs of trading. Finally, at an institutional level, trading is treated as a business, not as a form of entertainment. This is a critical distinction. Every decision is made with a focus on long-term sustainability. Risk is controlled, performance is tracked, and processes are continuously refined. There is no reliance on luck or impulse. Everything is structured. This is the mindset you need to develop if you want to progress beyond the beginner stage. Trading is not about excitement, it is about execution. It is about making calculated decisions in an uncertain environment and managing those decisions over time. Once you begin to approach trading in this way, your entire perspective shifts. You move away from chasing outcomes and towards building a process that can produce results consistently. Now the focus shifts towards practical application, because understanding concepts is only valuable if you can apply them in a structured way. When approaching a trade, the first step is always clarity. You begin by asking a simple but powerful question. What is the idea behind this trade? This forces you to define your reasoning before taking any action. It might be based on economic strength, market sentiment, or a broader directional bias, but the key is that it must be clear and logical. Once that idea is defined, the next step is to determine what would prove it wrong. This is where risk management becomes embedded in the process. If you cannot clearly define where you are wrong, then the trade should not be taken. This single step removes a large amount of emotional decision making, because it sets boundaries before the trade even begins. After defining the idea and the invalidation point, the next step is execution. This is where many traders become inconsistent. Execution should not be reactive or impulsive. It should follow a predefined structure. You decide in advance how much you are willing to risk on the trade, and you size your position accordingly. This ensures that no single trade can significantly damage your account. Then you enter the trade based on your plan, not based on emotion or hesitation. Once in the trade, the focus shifts from decision making to management. This is another area where discipline is critical. Many beginners interfere with their trades too early, closing positions out of fear or holding on to losses out of hope. Professional traders avoid this by sticking to their predefined rules. They allow the trade to play out according to the logic that justified it in the first place. Now, this is where reflection and improvement come into play. After the trade is complete, whether it results in a profit or a loss, the process is not finished. This is where you review the trade objectively. You look at whether the trade followed your plan, whether your reasoning was valid, and whether your execution was consistent. This step is essential because it is where learning happens. Without review, there is no feedback loop. You remain stuck at the same level of understanding. With consistent review, patterns begin to emerge. You start to see which types of trades perform well and which do not. Over time, this allows you to refine your approach and strengthen your edge. This is how progress is made in trading, not through isolated wins, but through continuous improvement. At this stage, you can begin to see the full picture of what trading actually involves. It is not about finding a single strategy or a perfect setup. It is about building a structured process that integrates understanding, execution, and review. Every part of this process is connected. Your edge defines your opportunities. Your risk management protects your capital. Your discipline ensures consistency, and your review process drives improvement. When all of these elements are aligned, trading becomes far more controlled and far less emotional. This is what separates those who approach trading casually from those who treat it as a professional pursuit. The difference is not in intelligence or talent, it is in structure and consistency. To bring everything together, Forex trading is best understood as a skill that develops over time. It requires patience, discipline, and a willingness to learn from both success and failure. There are no shortcuts, there are no guarantees, but there is a clear path for those who approach it correctly, focus on building a strong foundation, understand the mechanics, develop a structured process, and commit to consistent execution. If you do that, you place yourself in a position where progress becomes inevitable, and that is the real goal, not quick profits, but long-term competence. If you found this valuable, make sure to like, comment, and share your biggest takeaway, and subscribe for more institutional level trading education.